If you're like most Australians, you're probably confused and a little concerned about what's happening in our financial markets and how it's going to affect you and your investment properties. Hi, I'm Michael Yardney, and since the US government was downgraded from a AAA rating to a AA+, media commentators have been working themselves into a frenzy about what's ahead for Australia. Look, one minute we're hearing interest rates going up and then they're going to go down and then they're going to go sideways. Share markets, both locally and around the world, have wiped billions and billions of dollars of people's superannuations off, and the Australian dollar has fallen significantly from its high. Let's face it, as a property investor, you're probably asking, what does this mean for my property investments? Well, I'm going to explain in this market update, but before I do, I want to remind you that I'm in the middle of a round of seminars around Australia that I've called the How to Prosper in a Flat and Falling Property Market. Together with finance expert Rolf Schaefer and accountant Ken Race, we're going to give you our years of experience, because we've actually traded through markets like this before. We've done a lot of homework and research and actually fully updated the content just in the last week or so because of all that's happening. So click on the link below and join us at our How to Prosper in a Flat or Falling Property Market seminar. Now back to the question of what's happening here. Look, we're in uncharted water, so I don't have all the answers. But let's step back a bit and let's have a look at some things realistically with a bit of a question and answer. I guess one of the first questions is, what happened and how did we get ourselves into this mess? Well, ratings agency Standard & Poor's decision to lower the US credit rating essentially confirmed what most property investors already knew. There's a very small but increased risk that the American government won't be able to meet its repayments on its debts, on those treasury bonds, or at least not in a timely manner. Now, this is the first ever downgrade to the credit rating of the world's largest economy, and it was foreshadowed by Standard & Poor's, which said it was more concerned with the ability of the US politicians to reach an agreement to stabilise the nation's growing debt than it was actually worried about a double-dip recession. It was sort of a wake-up call for those squabbling US politicians. But of course the psychological impact of investors was devastating, and share markets plunged around the world, wiping billions and billions of dollars off people's retirement funds. In essence, all this has come about because the US and various European countries exhibited poor economic management, and they took on too much debt. Well, another question you may ask is, how is this different to the global financial crisis? The big difference this time round is, it's not mums and dads or banks that are going broke. This time it's countries that can't pay their debts. So it's likely that the subprime crisis will be completely dwarfed by the sovereign debt crisis that's now unravelling. So how are the US and the European nations going to get themselves out of trouble? If you look back in the past, historically, countries would either write off their debt, and that's probably unacceptable today, or renegotiate their debt, and that's what they're doing in Europe, isn't it? Or they could repay their debt with currency that is worth less by printing money and creating inflation. It's not worthless, but they create inflation and the debt seems to go away. So what does this mean for world economic growth? The International Monetary Fund still projects the world's economy is going to advance at a very healthy 4 to 5% per annum this year and next. You see, the so-called G7 economies, the big countries, the US, UK, Germany, France, Japan, Italy and Canada, they only account for 30% of the global economic growth. The higher growth emerging and developing countries account for about 60% of the world's economy. And this is important because around 40% of Australia's exports go to two of these countries alone, China and India. Now, in some ways, this is the beginning of a new financial era. It's a sign that the global centre of economic gravity is shifting away from the North Atlantic to countries towards Asia. Luckily, Australia is situated in this region and possesses the vital ingredients these high-powered nations require. As China and India move through their stages of industrialisation and urbanisation, they're going to require our natural resources, things like our iron ore, our coal, our steel, our natural gas, things like energy. So you may be asking, well, how's Australia's economy performing? The global financial crisis came as a surprise to most of the world, but since then every country's been preparing themselves to handle similar situations. So while Australia went into the global financial crisis with a budget surplus, allowing it to spend up big on incentive packages and things like that, we're now in a bit of a deficit. But still our economy is very healthy. It's actually the envy of, I think, almost every developed country. We've got a lot less debt than most other countries. Look, we're virtually at full employment and wages and disposable income are rising. As a result, our household budgets are healthy because many of us are continuing to stash our cash rather than spend it. Also, our interest rates are high enough to be reduced 2 or 3% to give that sort of incentive if necessary if we're going to get into a bit of a recession. So back to the original question I asked, you're probably thinking, what does this mean for property? In the past, every time there's been a stock market crash, investors lost confidence in paper assets. And what they've done is move their money into tangible assets, things such as gold, such as silver, and particularly property. The bottom line, after an initial lull in activity, it's common to see several years of good property performance after a stock market correction. So in the short term, I see the luxury end of the property market suffering, but the news is better for properties in the middle and lower price brackets. Well, let's go back a step and have a look how properties performed after previous stock market collapses. Compared to shares, property performed really, really well. You just have to look back a few years till the GFC. What happened after that correction? The stock market plummeted 50%, but peak to trough the property market, Australian home values overall, sure there are exceptions, but overall dropped just 3 to 4%. And it was much the same in 1987 when the share market crashed and property values languished for a while before a property boom that created fortunes. And let's not forget the property boom that we experienced in 2001 to 2003 in Australia after the dot-com share market collapsed into what many of us knew as the tech wreck in 2001. Now, you're probably wondering what's going to happen to interest rates. Look, there are so many factors at play, but I think rates are probably going to come down for a while. It's already evidenced when you look at what's happening because a number of the banks have lowered their long-term fixed interest rates. Of course, if we end up with massive inflation, partly because we're importing inflation through a falling Australian dollar, then the Reserve Bank's probably going to have to raise interest rates. But I think they're going to turn a blind eye to the slight increases in inflation over the next couple of months. So here's my conclusion. The reality is that these problems are not going to go away quickly, and we're entering a new era in our financial markets. After 3 years of uncertainty, the average Australians lost confidence in the share market, and baby boomers in particular are going to be hurting. Think about it, their retirement savings have once again been decimated. So after the initial shell shock wears off, I think many Australians are going to want to manage their own financial affairs. And I see more money going into self-managed super funds to purchase properties. So here's my recommendation for you. Firstly, this is not a time to panic or make rash emotional decisions. It is a time to learn from history. Look back at what happened during and post the global financial crisis, during the tech wreck of 2001, during the Asian stock market crash in the mid-90s, during the stock market and after the stock market crash of 1987. There's no denying that things are probably going to get a bit worse before they get better. But then the property market's going to boom. Now, why are they going to get worse? Well, look, don't get me wrong. I'm not suggesting this because I'm a fearful person or because I think negatively. I'm not, and I don't. I understand and firmly believe that all progress comes from change. I believe that destruction allows for creation, oftentimes through bigger and better things. Now, if I didn't subscribe to that theory, I probably wouldn't be much of a property developer, would I? So what we're going through is part of the economic cycle. This is a time for cleaning up the excesses of the past and getting our financial houses in order to move to the next stage of the economic cycle. It'll take time, but we're going to move through to the recovery stage. I found that when things are bad, people think they're going to be bad forever. And when things are good, people forget that bad times ever existed. They think things are going to remain good forever. And you know what? Neither case is true. Remember, when things are bad, they're never as bad as they seem, and when things are good, they're never as good as they seem. And in reality, it's primarily human nature that dictates economic and market booms and busts. What this means is that to protect your assets and to be a successful investor, over the next few years, it's very likely you're going to need to do different things and take a different approach to ones you've taken over the last few years. Some viewers are definitely going to need to do things differently to protect their current property portfolio. And I'm going to be explaining exactly what I'm doing at our How to Prosper in a Flat and Falling Property Market one-day trainings that I'm conducting around Australia. So please click on the link down below and reserve your place. In the meantime, I'm going to keep you up to date about what's happening and what you can do about it in future property updates. But it's also probably appropriate to remind you that in changing times like we're experiencing, no one can help you quite like the independent and unbiased investment strategists at Metropole. Remember, the multi-award winning team have got no properties for sale at Metropole, so their advice can be independent and unbiased. If you want to find out a bit more about what's happening in your local market, and what our research suggests is in store, please join us at a free property briefing in Melbourne, Sydney and Brisbane, or with our associates in Perth. Just click on the link below and find out more and reserve your place. As there's so much happening in our property markets nowadays, I'm going to keep you updated daily in my blog. So just click on the Michael's blog link at the top of this page and subscribe to it. You see, that's a different subscription to my regular newsletter. It gives you short daily updates. I look forward to sending you another video market update in 2 weeks' time. In the meantime, have a great week. Make it a great week. This is Michael Yardney.